Global economies and world markets performed strongly in 2013, but will this upward trend continue? To give us some insight into the year ahead and what investors need to keep an eye on, we're joined by Paul Bloxham, Chief Economist at HSBC. Paul, welcome to the program.
Thank you. Good to be here.
Excellent. So, firstly, the world economy and global markets had a good year in 2013. What's the HSBC view on the year ahead?
Look, if you look at 2013, we did see global growth was a bit below trend, but as you say, markets performed very well. Equity markets were very strong in particular. As you look into 2014, what we've got in mind is we've got the advanced economies picking up a bit from here. We think that the US is on a road to recovery. We think growth will lift from about 1.7% in 2013 to about 2.3%. That's not stellar growth, but it's certainly an improvement for the US economy, so a gradual road to recovery. And we've got in mind that Europe also stabilises. But if you look across to Asia, we've actually got in mind that Asian growth will be pretty similar to 2013. That is, we don't think there's going to be a particular improvement in Asia. We think Chinese growth will be about the same in 2014 as it was in 2013. And we don't think the lift in the advanced economies will necessarily translate into a particular improvement in trade in Asia. So overall, we've got global growth lifting a little, led by the advanced economies. But of course, from Australia's perspective, that's not actually necessarily an overly favourable story. It would be better if it was led by Asia for Australia. So the global economy might not give Australia the same sort of lift that it has in previous recoveries.
And what sort of growth are you forecasting for Australia in 2014 in terms of GDP?
Look, we've got in mind growth will lift a bit into 2014 as well, mostly to do with local factors. So we've got growth lifting from about 2.5% in 2013 to lifting to about 2.8% in 2014. But as I say, it's mostly local factors. We think that rebalancing story is going to pick up steam. The housing market's already booming. House prices are already rising very quickly. We're seeing signs that that's feeding through to the construction cycle. So building approvals have risen, and we're expecting a strong pickup in housing construction in 2014. And we're expecting that pickup in housing construction, that pickup in house prices to flow through to a little bit more consumption as well. So broadly speaking, we've got in mind growth rebalances into 2014 further, and that sees an overall pickup in growth.
So next question, what are your thoughts on tapering and the impact that will have on the market? And do you think, I guess a double-barreled question, do you think Yellen will be cautious with how she actually does taper?
Well, I think it's a really interesting question. I think that the Fed has obviously started their tapering program, and they've given hints that they're going to continue it. We think that that's going to happen. We think tapering is going to continue through the year, and by the time you get to about October, November, we think the quantitative easing program will actually be done. We think that you'll get enough growth. A lift from 1.7 to 2.3 will be enough to motivate the Federal Reserve to do that. But it's interesting that you note that Yellen, of course, is thought of as a bit more dovish than other central bankers, potentially as dovish as Ben Bernanke, or maybe a little bit more. So it's quite possible the risk here is that quantitative easing program lasts for a bit longer. One thing that's really interesting to note actually is obviously the nomination that Obama has nominated Stanley Fischer to be the second in charge at the Fed overnight. So Stanley Fischer is probably a little bit more hawkish. He might balance her out just a bit, because Stanley Fischer was running the Bank of Israel. He did that very, very well. He did that, kept inflation under control. Perhaps that will have some impact, some bearing on how dovish Yellen might actually be.
Currency. What are you seeing there? You know, a lot of people in the industry are talking about, you know, I guess a ban from, you know, sort of 80 to 85 cents. What's the HSBC view?
Look, we have in mind the Aussie dollar's got a bit of downside, that it can come down from where it is, sitting around 90 cents at the moment, towards 86 by the end of the year. So we've got in mind it does come down a little bit further. But of course, that would just be a modest decline in the scheme of things. We think the big shorting opportunity on the Aussie dollar, the big sell-off in the Aussie dollar, was through 2013. Of course, it fell from about 105 down to 90 cents. So we've got in mind it edges down a little bit further as that tapering program, as the tapering of quantitative easing continues through 2014. But we don't have in mind the Aussie dollar drops much below 86, 85 cents.
Okay. China. Obviously a critical market to the Australian economy. What's your view here? And can you talk us through, I guess, the ongoing talk of this credit crunch and what that means?
Well, look, we think China's going to have a year of consolidation. I think that's probably a reasonable way to describe it. They've really put reform at the head of what they're trying to do, reform and quality growth ahead of necessarily pump priming their economy. So, look, overall we think growth will be similar this year. We think it'll be around about 7.5% to what we saw in 2013. Compositionally, of course, we think it's very important to look at the composition of what's going on in Chinese growth. We think that infrastructure investment story will continue, which we think will support commodity prices for Australia. And you're absolutely right to note that of course, they've had some issues in their financial markets. Their short-term money markets have tightened up. We think that really largely reflects an ongoing reform of the banking system. They know their shadow banking system has been growing too quickly. That is, the lenders outside of the banking system have been growing too quickly. They are concerned about the levels of debt in the shadow banking system. And one of the ways that they're trying to slow the pace of growth down in that particular part of the financial system is by tightening up credit standards, and that's what they've been doing in the interbank market recently. So, look, we don't think what we're seeing is something particularly unusual or anything to get particularly worried about. It's a part of what the PBOC and what the authorities are trying to do in terms of shoring up the Chinese economy.
Good answer. So, interest rates. What's the house view there in Australia?
For Australia,
yeah.
Look, we have in mind, and we've had in mind for a while, that the RBA isn't going to feel the need to cut interest rates any further. They seem pretty reluctant to want to cut interest rates further. As Glenn Stevens said just before Christmas, that his view is that it's not interest rates that are constraining businesses' willingness to invest at the moment. It's their lack of confidence. And so he's really effectively saying the RBA's job is largely done. Interest rates are already low. Interest rates are not standing in the way of that rebalancing of the economy. And of course, the other factor to keep in mind is that interest rates are already low enough that they've driven a housing boom. House prices are up 10% over the past year. We think that's going to persist. We think that's going to see an upswing in the housing construction cycle. So we think the RBA's job in terms of interest rates is done. Now, of course, what they've been doing instead is they've been jawboning the Aussie dollar lower, and so far that's had some success. I mean, it's come down from sitting around 95, 96 down to sitting around 90 cents and a little bit below. So I think the RBA will continue to emphasise that they want the Aussie dollar to be a bit lower. They think it needs to fall a bit further, but I don't think we're likely to see them cutting interest rates further. Indeed, by the end of the year, I would expect that we might actually see them having to start to lift interest rates.
Important question. There's been a fair bit of talk about a housing bubble. What's the House view in relation to that issue, Paul?
Look, I travel the world and get this question all the time, and you get this question in particular from hedge funds on the east coast of the US who say, what do you think of Australia's housing bubble? And my reply is always, what bubble? Australia doesn't have a housing bubble. Look, my view is house prices are not unusually high if you compare them to the right set of countries. If you compare Australia's house price to income ratio across a range of countries across the world, actually we're about middle of the pack. It's not particularly it's not extraordinarily high. What we're seeing right now in terms of the house price cycle, as I said, house prices are up 10% over the past year. That's after having fallen by about 10% over the 18 months to the middle of 2012. So what we're seeing so far is something that looks pretty normal. It looks like the normal part of a housing cycle. House prices fell and now they're rising and they're recollecting the losses they made previously. The only place where you'd see some signs that things are perhaps getting ahead of themselves are Sydney. The Sydney market is picking up very strongly, but we'd expect that to subside just a little bit, to slow down a little bit as this year progresses. We don't think Australia has a housing bubble. What we're seeing is a normal part of a housing upswing.
Okay, last question before we go. In early February, the US Congress is due to renegotiate the debt ceiling. Can you see any issues arising out of these negotiations, and what are you thinking here?
Look, I think it's going to be good fodder for newscasters. It's going to be something that we're all watching in the media. But I actually don't think it's going to have that much bearing on markets. And it really comes down to this. It's a bit of the boy who cried wolf type story. Because if you remember back in October, of course, the US government shut down. We had a US government shutdown. We had the threat that they might default on their debts. The government was shut down for 16 days and then reopened. Even back then, bond markets didn't really think there was much of a chance that the US was going to default on its debt. And of course, having done that once and having got to the 11th hour and then called it off, and actually opened up the government again and not defaulted on its debts. I think repeating this game means that markets don't believe that they would actually go as far as actually seeing a default. So look, I think the story is going to be that even though it's going to make some interesting headlines,
Paul,
it's going to have limited market implications.
We're out of time there. Thank you very much.
No worries.
After the break, we'll take a look at the property space with Charles Tarby and find out whether income prices will continue to rise.